More than 36% of properties have had their asking prices cut at least once, the highest figure since 2011. The Office for Budget Responsibility predicts a 4.7% decline in UK house prices in 2024. Applying this to London, where the average property cost $537,000 in September 2023, a 4.7% drop in a value of £511,761, representing a 7.6% fall since the 2022 peak. The OBR is a non-departmental public body funded by the UK Treasury that provide independent economic forecasts and independent analysis of the public finances. They suggest that house prices may not recover to the 2022 levels until 2027. The forecast aligns with Savills' estimate, which anticipates a 3% decline across the UK and a 4% drop in London in 2024. Mortgage rates are expected to remain high, reaching 5% in 2027, impacting property prices. Despite the predicted decrease, property prices in London remain high, necessitating cheaper mortgage rates for market accessibility. The OBR also notes a 6.9% decrease in housing transactions, contributing to the affordability concerns. While the government extended its mortgage guarantee scheme, there were no changes to stamp duty schemes for homeowners or first-time buyers. The scheme is open to new 95% mortgages until the 30th of June 2025, which means you only need a 5% down payment. With participating lenders offering 95% mortgages under the government guarantee, we must take note of the date being July 2025, which coincides with the 18.6-year real estate cycle. Maybe they have plotted the cycle out themselves and want one last hoorah from the housing markets before risk becomes too much. The point of this scheme is because the government aims to support aspiring homeowners by introducing a mortgage guarantee scheme. The scheme, reminiscent of 2013 Help to Buy, allows lenders to purchase a government guarantee, facilitating high LTV lending to credit-worthy customers. The guarantee compensates losses in case of foreclosure. The scheme targets residential mortgages on properties up to $600,000 with a loan-to-value of 91 to 95%. Now, this is a scary sign for the housing market and can once again lead to a housing bubble. If you look back at history, and with the idea that the government will bail out the banks and other lenders if necessary, the lenders can offset the majority of the risk by securitizing mortgages, and with the notion that the government will take the pitfall should house prices collapse. In other words, there will be no repercussions for bad loans. So listen closely to this. This is off of the scheme on the government's website. Lenders must offer a 5-year fixed rate product under the scheme. The government sets a cap of $3.9 billion on its contingency liability. National Savings and Investments will administer the scheme, and lenders will pay a commercial fee to ensure its self-financing nature. So whilst it suggests the lenders will have to finance the scheme, the $3.9 billion contingency is from funds which have been collected from taxes. It would be wise to think that if this contingency fund is depleted, it will need replenishing once again by none other than a courtesy of UK citizens, a self-fulfilling prophecy. This may sound upsetting for most. However, looking at history, this happens repeatedly, and at least those watching have the intelligence to do some further due diligence and see what is actually happening to negate any risk. So why have these, we can call them instruments, been extended? One interesting notion is that UK house sellers are reducing asking prices at the fastest rate in over a decade due to the increased interest rates and reduced summer demand. According to property website Rightmove, over 36% of properties on the market have seen at least one price reduction, some more. surpassing the pre-pandemic average of 31.2%. The average price reduction across Rightmove is 6.2%, which is the highest since January 2011. This suggests some sellers were overly optimistic initially, or the fact that we have seen negative year-on-year growth suggests that we are coming into the slowdown of the housing market. Nationwide and Halifax report selling prices falling at the fastest rate since 2009. Mortgage lenders have cut fixed rate deals. The Bank of England's potential interest rate hike may further impact borrowers. Despite some positive indicators, concerns about buyer confidence persist due to the market volatility in the past year. Average house prices are predicted to fall by a single-digit amount in 2023 and again in 2024. There is much speculation around when rates will finally be cut to stimulate the economy again. City economists are increasingly confident that the Bank of England will start to cut interest rates from their current 15-year highs next year. The money markets are currently predicting their rates will have been cut from 5.25% to 5% by next June. But some forecasters believe the cut will come in May 2024, which is a month when the bank is due to release one of its quarterly inflation reports. We can look at the statistics which show the average Fed pause last 7 months, which will bring us to March 2024. So by combining these predictions, we can expect interest rates to be cut in the 3-month window of March 2024 to June. If we are to take this stat, which states, if interest rates pause for 5 months, there has never been another rate hike, and 78% of the time, or 11 out of the past 14 rate hikes, had led to a recession. As we can see from this chart, the central banks know something is broken, as they've paused rates and are printing money behind the scenes to prop up markets. So the purple squiggly line here is related to the liquidity coming into the markets from the Federal Reserve. So if we look at the Fed funds rate on top of this, typically what we see is speculation starting again once the Fed pauses rates. But as this time around, something has slightly changed, arguably because enough damage was done during the COVID pandemic. But since this point, the Fed has started injecting funds, which has given new life and new breath to this move upwards. The US 10-year yield has shown us the first time frame reversal, and the longer treasuries often show us when the Fed is done raising rates. I'll quickly show you the 20 years as well. So you can see this across the board. So this also supports the time frame we mentioned earlier. The S&P 500 is still climbing, although we're just shy of filling this gap. So if we are going to start topping out, this would be the place to do so, and we'd have to see something like this. Then you see a sell somewhere in here. The Dow Transportation Index is still yet to break through the resistance which we mentioned in our previous video. And if you didn't see last week's video, be sure to check that out, as you'll see why we are watching these levels. Let's look at home builders quickly. Home builders are still in an uptrend. They broke that major resistance. This line here is where we have a slight gap, and obviously these gaps have higher probabilities of being filled. So the small caps, or the Russell 2000, did see a small time frame reversal, and if we take a look at consumer discretionary versus consumer staples, which is basically luxuries, things which are not compulsory, versus the necessities which we need. And if we lay over the Fed funding rate quickly, we typically see discretionary spending contract around or before the Fed pauses, because of the fact that money is harder to come by. The economy starts to contract, and the Fed is doing its job by hiking rates, and potentially enough rate hiking has already taken place. So by the time these pauses occurred, as you can see, discretionary spending has already started to go into a downtrend. It is important to note, we haven't necessarily seen a turn in price yet, and this is probably because of the excess savings we had accumulated due to the stimulus in the pandemic, and these savings have now been depleted. So levels to watch out for, or obviously this box here. And if we are going to go to higher highs, you're going to want to see this high be taken out, because at the moment this entire move looks similar to a Wyckoff schematic. So I'm going to wrap this one up here. I won't go into too much into the technical analysis because we've done enough last week and not too much has happened this week to report on. Be sure to like and subscribe, and I will be giving away some property consultations in the future. If there's anything you would like more information on, be sure to let me know in the comments.